The live intraday trading price for Datavault AI Inc., trading under the ticker symbol DVLT on the Nasdaq, is currently sitting at $0.5235 per share. This represents a downward intraday market movement of 5.93% from yesterday's closing price, with the stock oscillating between an early high of $0.5641 and a low of $0.5222. Volatility is striking the ticker hard today, with volume already pushing past 19 million shares traded as market participants digest a flood of massive structural updates. While a falling stock price usually signals panic on the street, what is happening behind the scenes with this company right now is completely detached from the superficial ticker movement. Retail investors looking at their standard stock screens see a struggling microcap stock down nearly 6% in the daily session, hovering near its annual lows. The reality that sophisticated market players are watching is that Datavault AI just signed a massive non-binding term sheet for a staggering $2 billion structured financing transaction. Let that number sink in for a minute. A company with a total market capitalization floating right around $450 million has entered a preliminary agreement to secure capital asset backing worth more than 4 times its entire equity value. This structural framework values the underlying shares at a massive premium between $1.55 and $2 apiece. The market narrative and public expectations say this is an overlooked penny stock losing momentum, but the institutional reality reveals an ambitious, high-stakes financial arrangement that could completely reshape the company's capital structure. This stark disparity between public sentiment and structural adjustments is exactly why the order flow is so heavy today. When looking for the right platform to navigate these high-velocity microcap setups, choosing the correct individual brokerage is essential. Active market participants looking closely at microcap movements often turn to institutional-grade systems like interactive brokers to capture real-time depth, or rely on specialized tools via SoFi Active Investing and the SoFi Trading platform to balance growth positions. Others prefer traditional stability through a Fidelity brokerage account to access Fidelity mutual funds, or utilize the streamlined infrastructure of the Robinhood app for instant liquidity. Even those looking for automated asset allocation through services like Schwab Intelligent Portfolios are increasingly forced to analyze how speculative tech positions impact a broader diversified strategy. The general market expectation for Datavault AI is built on standard tech sector skepticism. On paper, it looks like a business struggling with significant cash burn, posting a hefty net loss of $53.1 million in its first quarter report, despite showcasing rapid top-line growth. For casual observers browsing popular investing sites, the massive drop from its 52-week high of $4.1 down to these current sub-dollar levels makes it look like another speculative venture that ran out of steam. The contrarian take, however, requires looking past the immediate net losses to inspect the mechanics of their new $2 billion asset-backed financing agreement. This is not a standard corporate cash injection, where an investment bank hands over cash in exchange for immediate equity dilution. Instead, this deal is structured as an exchange of shares for preferred units in an investment vehicle holding fixed income securities. Datavault AI is essentially trying to manufacture a fortress-like collateral base to back a secured borrowing facility, which they plan to use to fund their upcoming digital asset exchange initiatives. The counterparty, a UK-based structured institutional investment platform, has even agreed to route all of its global digital tokenization and blockchain infrastructure initiatives exclusively through Datavault AI's platforms. The trading volume spike we are witnessing today is heavily tied to the strict, immediate financial deadlines hidden within this newly announced term sheet. While the headline figure of $2 billion sounds staggering, the agreement is structured in 4 successive tranches of up to $500 million each, with the first tranche targeted for the third quarter of this year. To keep this massive deal alive, Datavault AI faces a binding obligation to make a non-refundable payment of $25 million to cover administrative and structuring costs. That payment is due by June 4, 2026. The company has explicitly stated that the source of these funds will come from the strategic sale of Bitcoin holdings and existing receivables. When a company with an unstable cash position has to liquidate digital assets to meet a multi-million-dollar structuring fee for a non-binding agreement, institutional traders pay close attention. That explains the high volatility on the Nasdaq today, as short-term traders weigh the absolute execution risk of this massive capital restructure against the immense potential of a multi-billion-dollar exclusive tokenization mandate. To put the current institutional positioning into perspective, look at how the stock has behaved over the broader macroeconomic timeline this year. The stock has been under immense pressure, caught in a wider tech sector pullback that hammered speculative microcaps across major investing sites. For anyone managing their own capital through self-investing or seeking online investment help, analyzing a balance sheet like this requires looking at the raw operational momentum against the rising capital expenditures. Datavault AI reported a massive year-over-year revenue increase of 443% in its latest quarter earnings report, and management has firmly reiterated a full-year revenue target of at least $200 million for the calendar year. They claim to have locked in over $800 million in tokenization contracts this year alone. Yet despite this explosive revenue trajectory, the business remains deeply unprofitable, showing a trailing loss per share of $0.96. This creates a severe structural tug-of-war. The top-line expansion is incredibly steep, but the general administrative and engineering expenses are scaling up just as fast, keeping net margins deep in the red. For a clear understanding of the core operational model, we have to look at what Datavault AI actually does when it is not engineering massive corporate finance deals. Founded in 2010 and headquartered in Beaverton, Oregon, the company operates as a specialized data sciences and digital infrastructure provider. Their technology suite is centered on data valuation and monetization, helping major corporate clients identify, catalog, and secure financial value from their internal data silos. They deploy proprietary systems to observe, score, and price data assets securely, frequently integrating their solutions with prominent enterprise networks to offer compliance-focused data governance. Over time, the business has expanded its corporate footprint by acquiring diverse technology divisions. Their portfolio now includes specialized subsidiaries ranging from event registration analytics systems to high-performance audio transmission units. Their cloud platform bridges traditional enterprise data management with modern distributed ledger networks, seeking to establish automated systems where real-world assets can be tokenized, verified, and traded with cryptographic certainty. Comment below how many shares of Datavault AI you currently hold in your portfolio, or if you are avoiding microcap tech stocks entirely right now. Navigating a high-stakes asset like this requires a very clear view of the potential future catalysts and downside risks over the next 2 quarters. The immediate catalyst is undoubtedly the execution of the $500 million financing tranche. If the company successfully wires the $25 million fee and secures independent valuation clearance to close the initial portion of the deal by the 3rd quarter, it will immediately validate management strategy. This would provide the collateral base needed to launch their digital asset exchanges, potentially sparking a massive upward reassessment of the equity toward the structural value of $1.55 detailed in the term sheet. Furthermore, the exclusive global tokenization mandate from their institutional counterparty could translate into high-margin recurring software revenues, giving the company a clear path to achieve its aggressive $200 million revenue goal. Investors using platforms like Robinhood Investments or checking their positions on the Fidelity mobile app will be keeping a laser focus on these regulatory and operational updates over the coming weeks. Conversely, the downside risks are remarkably steep and should not be overlooked by anyone engaged in online investing. The current financing agreement is entirely non-binding, meaning the entire deal could fall apart during the due diligence phase or fail to receive necessary regulatory approvals. If the deal collapses after the company spends $25 million in non-refundable fees funded by liquidating corporate Bitcoin, the impact on shareholder equity and overall market confidence would be severe. There is also a major governance shift tied to this capital injection. If all 4 tranches are successfully completed, the counterparty will gain the right to nominate a majority of the 9-member board of directors, effectively handing over corporate control to an outside institutional fund. Additionally, the sheer volume of shares required to fund a $2 billion transaction at a $2 valuation implies a massive long-term dilution risk for existing retail shareholders who bought in at higher historical prices. When we sum up the current state of Datavault AI, the contrast between short-term expectation and underlying reality becomes undeniably clear. The immediate market expectation, driven by a 5.93% intraday decline to $0.5235, views the company through a lens of defensive skepticism, focusing heavily on past financial losses and structural volatility. The deeper institutional reality, however, reveals a company attempting an incredibly bold, multi-billion-dollar asset-backed corporate transformation. By locking down an exclusive global tokenization mandate and leveraging a massive fixed income portfolio to secure institutional credit lines, management is making an all-or-nothing bet on the scaling power of their distributed data platforms. Whether this venture results in a historic turnaround that closes the massive gap to its analyst price targets or serves as a warning sign of microcap overextension depends entirely on execution over the next 90 days. Keeping an analytical level head and tracking the raw data will remain paramount as this complex corporate narrative continues to unfold on the public exchanges. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.